Hey, good afternoon and welcome. My name is Matt Price with the Price Group, and today we will be talking about the retirement planning timeline. So, a lot to cover, but before we jump in, expectation right around 30 minutes or so, uh, plus or minus 5 minutes maybe. And, we think there are quite a few things we need to do leading up to retirement to be ready. So, waiting here for all the names to kind of trickle in. I see a few familiar faces, so welcome back. A few new names as well. But make this, stop me along the way, type any questions in, or typically we get most of our questions offline by email or by phone call after the presentation. So don't be a stranger if something is confusing or you would like to learn more, pick up the phone, give us a call. We're here to help. But a little bit about us. Randy, he tried to tell you he's my older brother, but he's actually my father. Myself, Maddie Kearns, make up the three advisors for the Price Group. We follow a fiduciary standard. We think that's very important. We have a retirement niche. Over 80% of our clients are, in fact, retired. We think in retirement, you don't need a generalist, but you need a specialist. So we see a lot of people across the city or state that help people with investments, but we don't see many that really specialize in the retirement area. A little bit more, all three of us, Randy, Maddie, and myself, are certified financial planners. Randy and I went to the Wharton School of Business to get our CIMA, Certified Investment Management Analyst designation. Randy's gotten a few awards from Barron's, Forbes. I've gotten a few from Forbes and a few others as well. So we've been humbled to get some recognition on that front. Our firm, Steward Partners, is based off the biblical definition of stewardship. And our primary custodian is Raymond James. So that's where client assets are held. They've been a great vendor, a great partner of ours over the years, a very fiscally conservative operation, which we think is paramount in this type of environment. So what are we going to talk about? We're going to talk about planning 2 to 5 years out. We're going to see what planning looks like less than a year out. And then retirement, it's not a one-time event. There's planning to do after retirement as well. We'll look at that. Let's start with the 2 to 5 years. We think it's really important to look before you leave. We think that is creating a wealth plan. We call ours a live well plan. We call it that because we're a little bit cheesy and couldn't come up with a better name. But deep down, we really want clients to live well in retirement. So developing that plan includes cash flow projections, estate planning. What does an investment portfolio look like? How are you going to take income? What is the correct way to file for Social Security benefits, for Medicare? Go down the list. There's dozens and dozens of things that we cover in that plan. We do that on a complimentary basis, by the way, for families approaching retirement. But in that plan, we develop what we call our family index number. What rate of return do you need to be, quote, successful in retirement? And we define success as meeting your goals and having a certain amount of money left into your early or mid 90s. Also, we need to evaluate the retirement plan contributions. Are you adding to a Roth? Are you adding to a pre-tax account? Are we making sure we're taking advantage of the company match? What does non-qualified deferred comp investment options look like, et cetera? And we need to really kind of take a step back and consider, hey, what does a bad year in the stock market do? Is it going to push out my retirement a year? The answer can be yes. The answer can be no, depending on how you're balanced within your investment risk. And we think now's the time actually to hire an advisor, someone who specializes in retirement planning. We think that 2 to 5 year time frame allows you to it's enough time to make material changes if they are necessary for your family. So this is a look at what the sequence of returns means in retirement. And we start to really talk about this with clients in this time period, that 2 to 5 years out from retirement. But a little bit of a busy page. I want to draw your attention to the two boxes on the left. In the top left box specifically, you see we're starting with $100,000, but in that top left box, we're getting a negative 15% rate of return in year one. You get 7% rates of return from years 2 through 9. And then you have a really nice year up 29% in that 10th year. What happens? You end that top left box once again with $188,399. And this is while you're still working. So let's compare that to the bottom left-hand box, once again, while you're still working, and just flip the returns. Get your good return up front, your bad return at the end, you can see what happens down to the penny. You have the same amount of money after 10 years. So the bottom line is this: the sequence of returns, it does not really matter while you're still working. Whether you get your good returns in your 30s or your 50s or you flip them, you're still going to end up in the same spot. The caveat would be that you're saving the same amount year over year. Now, let's look at the two boxes on the right with a stark contrast to the two boxes on the left. The upper right-hand box shows a negative year, your first year of retirement, negative 15%. And the only other piece of information we're adding is that you're taking out $10,000 a year. You can see in that top right-hand box, you run out of money somewhere between years 9 and 10. But if you start retirement with a good year, now looking in the bottom right-hand box, take out the same amount of money, you get to the end of your 10th year with over $52,000 left in the plan. So the bottom line is this: sequence of return really matters. An Excel spreadsheet can actually do a pretty good job for your retirement planning up until retirement, but that spreadsheet becomes woefully inadequate in retirement because of this. We do what we call, and I'm sure many of you are familiar, Monte Carlo simulations. So we actually show you going through retirement 1,000 times to take this sequence of returns into account. But we think you also need more than just an investment guide. You know, we like to think we're pretty good at the investments, but we think a holistic plan is really paramount. That includes retirement, tax planning, investments, insurance, cash flow needs, estate planning, and more. But we love this quote by Benjamin Graham, who is one of Warren Buffett's mentors: the best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. So we think planning is key, especially in this 2 to 5 years out from retirement. So I said earlier, retirement, it's not an event, it's an ongoing process. We don't think that you actually have a retirement plan unless it's written down. We've met dozens of really, really smart families, and we ask, hey, tell us about your retirement plan. And they kind of say, I got it up here. We don't think that's adequate, but we think a retirement plan at the very minimum needs to include how much are you spending in retirement, how much will your money last. We talked about it earlier, the family index number, what rate of return do you need to be successful? And then for a lot of families, it's a real stark difference investing before retirement to investing in retirement, because in retirement, you obviously need income. So once again, recommend our Live Well plan. We do that on a complimentary basis if anyone is interested. A little bit more about that family index number. It's a personalized rate of return to track your progress up until and through retirement. So this is not something that's just a cookie cutter. Every family gets the same family index number. It's peculiar to your own situation, when you're retiring, how much risk you want to take, what income needs do you have, etc. And we try to cut out a lot of the noise, and instead of just comparing your portfolio to the bond market or the stock market or a combination of both, we compare it, in addition to those, to just this family index number, which ultimately helps clients figure out, hey, am I ahead of track, or am I behind track, or maybe I'm just right on track. And that's really the feedback we get from people in retirement. They're asking the question in a lot of different ways, but maybe the heart of the question or the root of the question is, how am I doing? Are we kind of meeting our expectations? And our family index number is one of the tools we use to help answer that. So we like to throw in a little bit of just what can we do now type of advice. And this is an alternative Roth IRA contribution, sometimes known as a backdoor Roth contribution, but maybe you're familiar with this, maybe you're not. What you do is you put money into a traditional IRA. It is a non-deductible IRA, very important. And then you convert that, it can be the very next day, to a Roth IRA. Now, the money that you put into the IRA, when you convert it, is not taxable because you did that with after-tax dollars and did not take the deduction, hence the non-deductible IRA. Any growth on that would be taxed. But the way that a lot of people don't understand, the pro rata rule is a place where you can stub your toe. Unfortunately, you need to include all other IRA dollars when doing this calculation. Say you have $1 million IRA, you're trying to do a backdoor Roth IRA for $7,000 this year. The strategies just won't work as well because you have to pay taxes on the pro rata amount, 7,000 as a percentage now of 1 million and 7,000. So it works really well if there are no other IRA assets. Our understanding of the rule is the 401k assets are not included. That'd be something good to run by your CPA though. 401ks and IRAs, while they seem like they're very similar, there are a few salient differences, and this is one of them. So our understanding is you can still do it, not include the 401k assets in that amount. The other idea, and this would apply to maybe some of you specifically that have the option of putting after-tax dollars into your 401k plan at work. And what you can do there is you can add money to the after-tax bucket, and it works pretty similar to actually the Roth conversion. You can convert that into the Roth amount every year, or you can do it actually at retirement when you're leaving the company. But you can max out the Roth IRA, or excuse me, the Roth 401k portion, then max out the after-tax portion, and then just convert that after-tax portion into the Roth. So it's a way to supercharge that Roth 401k that the company has. You know, most every 401k provider these days has a Roth 401k. Not all 401k providers offer that after-tax option. So that's a look within your plan. We're happy to take a look at your plan as well to provide some feedback on that. Another question to ask, would a 25% correction in the stock market delay your retirement? What we're looking at here, this is a time period from 2000 to 2015, and the purple line represents the S&P 500, but the green line represents only half of the risk. So getting half of the downside, but you're only getting half of the upside, and how you come out, and the results are a little bit staggering. You end up better off in this 15-year period by taking less risk, just because, you know, from 2000 to 2010, you've probably heard it referred to as the lost decade for stocks. The bottom line, in our humble opinion, is once you're within 5 years of retirement, let's take a look, see what type of risk you're actually taking. And it could be a good time to actually reduce that risk. How do you factor in a potential pension lump sum that some companies offer? You know, that's a conversation that's specific to every family, but that obviously needs to be taken into account. But overall, let's get just more comfortable with the type of risk and the amount of risk that we're taking leading up to retirement. And the last piece of advice we would have for families 2 to 5 years from retirement would be, like we said earlier, we think now's the time to hire a qualified advisor. And looking at the 30-year returns there on the right-hand side, look how the average fund investor has done versus just stocks versus bonds. You know, the average fixed income fund investor actually has more drastically underperformed the bond market than on the stock side. But we would say now is the time to consider hiring someone. Just going through retirement, it's a sea change when compared to just saving for retirement. And you only get one chance to do it right is the way we look at it. So let's transition to the planning less than 1 year out. And here's just kind of an overview. We'll talk about a few of these in more detail, but let's really hone in on what are your retirement income needs. How much money are you going to need in retirement? Pension versus lump sum. We have a full part of our process within our Live Well plan is talking through that. We have a bona fide spreadsheet that really helps you compare and contrast the pros and cons. Are you under 59 and a half? We've had quite a few families here over the last year or so retire under 59 and a half, and getting money out of the 401ks is possible. Just there's a few different ways you need to do it. Creating your income strategy. What's the company discount rate as it pertains to the pension lump sum? That can have a real big effect. You know, typically For most plans, it's a 0.25% move in interest rates can represent about a 2 to a 3% move in the pension lump sum value. So interest rates down, pension lump sum value up, and then vice versa is also true. What are ordinary income versus capital gains rates? And if you haven't hired an advisor, we think now is the time to do it. But income in retirement, this is a big thing we talk about with that Live Well plan. We think inflation in retirement really is the hidden tax. We need to make sure we include that. Randy, who has 5 children, I'm the first of 5, now has 10 grandkids, I think. I could be off by a few. But he likes to say the bank of mom and dad is always open. So that's something we need to take into account. Big ticket items, or how we're doing on cars, does the roof need to be replaced, etc. We see a lot of families wanting to plan their retirement trip, but a big international trip or a big domestic trip every year, every other year. And then gifts, a lot of our clients have been really charitable in their working years, and they don't plan to stop that in retirement. So how do we plan for charity, whether it's to your church, any other 501c3 organization in retirement? We want to take that into account. One last thing, and this is a little bit of a rule of thumb, but it depends how much gross income you make, but a rule of thumb could be 70 to 80% of your final year salary is typically what we see people spend in retirement. So what we have found is people don't actually end up changing any of their spending habits. So if you're spending $125,000 a year now and a few years leading up to retirement, there's going to be a few expenses that are really eliminated, or expenses that move lower. You're not driving in the office, maybe you're not buying as many work clothes, you're not eating out for lunch as much, but you're going to get some new expenses, whether that's healthcare, whether that's more travel, go down the list. And it's going to be that 70 to 80%, sometimes even up to 100% of what you're currently spending. But I would say the bottom line, people really don't change habits this late in the game on the eve of retirement. So what you're spending now, probably pretty close to what you're going to be spending in retirement. Is 3% the new 4%? That was a catchy phrase a few years ago, and we had one client a few years back say something along the lines of, Randy, Matt, you're telling me I need to spend 4%, but 5% is just 1% more. What's the difference? And we thought that was a really good, very good question, but the difference is 1 is a percentage of 4, going from 4% to 5% is actually a 25% increase. So what you can see here is a look at that 4, 5, 6, 7, and 8% withdrawal rates. And depending how old you are, depending what your goals are on possibly leaving the next generation some money, this is something that needs to be studied. One could make an argument that 3% is the new 4%, though, just given the fact that interest rates are still considerably lower than the 70s, the 80s, even part of the 90s. So you had some more wind at the back, or more income being produced in those decades when this study was being done. Taking a look at the company pension versus the lump sum, there's a bunch of things to consider here, but I would say the few kind of main ones to hone in on: what do we think interest rates are going to do? Or maybe said another way, what do we think inflation is going to be? Where the company pension obviously is not going to adjust for inflation. You can, a lot of times with the lump sum, invest it in such a way that it can keep up and sometimes beat inflation. What are the goals of leaving the money to the next generation? We've seen it both ways. Sometimes it makes sense for families to take the pension. Other times it makes sense to take the lump sum. The bottom line is we think you need to walk through a bona fide plan to figure that out for yourself. And that's a big part of our Live Well plan, like I mentioned earlier. So retiring before 59 and a half, what does that look like? Taking a one-time distribution when you're rolling the accounts over, that's an option. 72T. That's where you can take equal and systematic payments for the greater of 5 years or until you're 59 and a half. Or maybe said another way, if you're 52, you would have to take the same amount of income out every year until you're 59 and a half. If you're 57, you'd have to do it for 5 years. So the younger you are, the more that can make sense. It also depends on how much after-tax dollars you have in your portfolio. Net unrealized appreciation, obviously another strategy that works best with some of the lower cost basis company stock, formerly the ESOP, the employee stock option plans, a line of credit. We see that used. Sometimes people are planning to work just part-time, doing something they love. We had a client move out of Texas, and she loved coffee, and she's become a real kind of, I'd say, integral part of their community through the local coffee house, and she just loves it. Not really doing it for the money, but she's really found some community there. Or I said sale of after-tax assets being another way. But bottom line is you can retire before 59 and a half. We just have to be a little more creative with that planning. So less than a year out, we're still looking at how do we produce income. We think dividend stocks are one of the best kept secrets for retirees. What we're looking at here is the dividend, the percentage of the total return. So the appreciation, the stock moving higher plus the dividend as a percentage of the total return by decade. And what you can see is the dividends actually represent a real material rate of return in most decades. So we're big believers in dividend paying stocks. That's something we would talk a lot about kind of within the context of your Live Well plan. How many dividend stocks versus bonds, that's really dependent upon the family and a number of specific life circumstances, how much money you need, what's your risk profile, et cetera. But we have a handful of dividend stock strategies and happy to explore those in more detail. But here's another page, and this is one of Randy's favorite pages in the presentation. I'll draw your attention here to 1981 to 2000. What happened in the early 80s? Well, interest rates were really high and they just went down. So there's a real wind at the back to make the bonds look good for investors. So I think most everyone would be happy with that 7% average return over a 20-year period. However, let's look at the other 20-year period, 20-year period from the early 60s to 1980, interest rates moved higher. And you actually lost money on an inflation-adjusted basis during that period. So where do interest rates go from here? There are a few big firms out there right now that think the 10-year U.S. government bond, which is really the primary interest rate barometer, actually go from around 4.4% today up to 5%. A lot of other people think interest rates move lower. So I would say right now it's a pretty mixed bag of what people are expecting as it pertains to interest rates. And I think it's becoming a bigger piece of that conversation. What happens with the national debt or national deficit year over year that is going to play into interest rates? Because at some point, international investors say, you know what, America, it's not the clean U.S. government bond that we've been purchasing for the last 10, 20, 30, 40 years. So stay tuned on that front to see what happens on possibly maybe reducing some of that government spending moving forward. We also think now is the time to really look and say, hey, how would I handle the next pullback from an emotional perspective? Say you had $2 million that you're retiring with, and let's just go back to COVID. All your money, say, is invested in stocks. We remember the month of March, the stock market as a whole was down almost 30% in 30 days. How would you do with 30% would represent about 600,000 of that 2 million if you woke up and you were 100% invested in stock and 2 million turned into 1.4 million? Are you going to panic? Are you going to want to buy more? How are you going to react? And I think that's a question that needs to be considered for each retiree or family approaching retirement. But what we can see here is investing without a process, the average person actually just sells at the most inopportune time. So what we're looking at is these red boxes. This is the end of 2002, early 2003, kind of the bottom. The market was down 2000, 2001, 2002. People sold at the bottom. Same thing happened late 2008, early 2009. Stocks are at their low, and people just get out, in a very drastic way. So we don't want that. The old saying, buy low and sell high, it's really true. But we have a methodical process for clients to produce income, to take the emotions out of it, and to have a bona fide game plan, not for if, but when there's some bumps in the road in retirement. So why do you need an investment process? We kind of just said it. We think discipline and income generation are really at the core of that. Our goal for clients is preserving assets, but at the same time, generating income to meet their needs with confidence. So easier said than done. It's a very dynamic thing, but it's something we talk about in detail with this Live Well plan when we put that together for families who are kind of kicking the tires, looking to see if this could be a good possible fit. So let's transition to planning after retirement. And what we need to do in retirement is continually stress test the portfolio. What we're looking at here is you've just started to say you just retired, you're taking 4% out of the portfolio, and the portfolio is down 20%. Maybe it'd be intuitive to say, well, I just need 20% just to get back to where I was. But when you're taking money out, it's this compounding effect. You actually need 36% just to get back to break even. So we say here internally, we win by not losing. 2022, a down year for the stock market. Our goal for our dividend stock portfolios was to be down less than the market when it was down. So say you were down 7% in 2022, it's so much easier to come back from a 7% down year compared to maybe a negative 20% year. And that's really how we think about investing in retirement, which once again is a real salient difference when compared to how people typically think about investing as they're accumulating, putting money in the 401k, etc. And here are a few other maybe tangible planning ideas. This is not a holistic or comprehensive list by any stretch, but holding assets that generate income in qualified accounts, qualified meaning 401ks or IRAs, just to help with some of the tax planning. Qualified charitable distributions or a QCD. You have to start taking RMDs or the required minimum distribution at age 73. However, at the age of 70 and a half, you can give away an amount of money directly to 501c3 charities. And once you turn 73, that can be offset against your RMDs, the amount that you're required to take out every year. So that's we think the most bang for your buck as it pertains to how to gift money. Gifting of appreciated stocks to church or charity of choice is something, we're talking right now, this time of year is when we're taking Roth conversions for clients. Maybe someone retires early, they haven't turned on Social Security, they're really just living off their after-tax assets. We want to, for most families, utilize or fully utilize that 10 and at least that 12% marginal tax bracket. We think it's a high honor in this country to pay tax at 10 or 12%. So using Roth conversions, that's a big piece of the overall plan. Said earlier, we think that planning should be benchmarked against your goals, not just against some arbitrary index, but what do you as a family actually need to be successful? So we would love to create a Live Well plan for you. Randy sometimes thinks he's an old Baptist pastor. He talks about comfort, confidence, and clarity. That's our goal when doing this exercise. It's a way for families to kick the tires with us. It's a way for us to kick the tires with families, see if it would possibly be a good fit, completely complementary. Our promise is you leave a more educated consumer on your own personal situation. So if you have any questions on that, feel free to shoot me a note. Be happy to set up a time to talk about that in more detail, gather the necessary information. We can do it by Zoom, do it in person, whatever works best. But with that being said, thank you for spending a few minutes with us. Looks like we're kind of right on time on that 30-minute mark. Once again, my name is Matt Price, along with Randy and Maddie, the rest of our team there, Preston, who actually just had a baby yesterday, Tiffany, who it's her birthday today. Happy birthday, Tiffany, and Melissa. So any other questions, let us know, but we look forward to hopefully speaking with each of you very soon. Take care.